Oil dipping below 80 bucks a barrel for the first time since January. That's before Russia invaded Ukraine. Remember, we hit 120 a barrel in early May. Energy was the worst performing sector in the S&P this week, falling 9%. For more on where prices are going next and whether further demand construction could possibly be ahead, let's bring in John Kilduff of Again Capital. He's also a CNBC contributor. John, great to have you with us tonight.
Good evening, Frank. Great to be with you.
So oil prices are obviously falling on the thoughts that there's going to be less demand. How much of those fears are coming from less demand in the U.S. and other parts of the country and slowing demand in China, where the lockdowns just haven't ended the way people thought they would?
No, that's right. And I'd say that the demand destruction fears really have gone global, given what the various central banks are trying to do to rein in inflation through this, curtailing economic activity. That goes right to the heart of energy demand. Although I'll say today, no matter what the commodity was, it was red on the screen for sure, and crude, led the way. But as long as China continues to struggle the way it has, and this has been going on for months, and even beyond the lockdowns, Frank, the economic data there has just been terrible. And their property market now rolling over, and they're trying to step in and do all kinds of economic stimulus to sort of put together a patchwork to stabilize the situation. It's not good. And, they are key to this market, to the oil market, on the demand side. They are as key on the demand side as Saudi Arabia is on the supply side. So to the extent China remains in tough shape, there's a severe headwind on crude oil prices. And then, of course, this soaring dollar only exacerbates the demand destruction around the world.
So, John, hard to believe we haven't brought this up until now, but actually last week, but also this week, the CEO of FedEx really pushing to slowing manufacturing out of China, slowing demand for transports and things like that, calling for a global recession, something that really spooked the markets last week. The report yesterday didn't do the markets any favor, I would imagine. How much of that is weighing on the markets? And then on the other hand, is there any chance the U.S. consumer can come in and save us? I'm looking at the gas prices right now. They're about 15% higher than they were a year ago, but that's a big break from what we saw just a few months ago. Is there any chance the U.S. consumer is going to get back out there on the road, get back out to traveling, and maybe save the oil market?
It doesn't look likely right now, Frank. I can tell you that the recent gasoline demand data has been horrible. Down 1 million barrels a day just about versus this time last year. It seems like the inflation damage has been done, if you will, on the U.S. consumer. And driving is just a discretionary item at this point that's not being picked up. We'll see if we get increased demand from when they take in the harvest now and the farmers for diesel fuel. That's a bit of a worry for the market. And to see if the leaf peepers here in the Northeast start to pick it up. That's something we used to closely watch, back in the day, not so much these days. So I'm not sure. The FedEx report coincides with overseas shipping rates from China that have just imploded. Also, too, the port congestion has seemingly disappeared. So all these sort of demand factors that I look at to try to gauge what the pressure is going to be on crude oil, for demand-wise and what it's going to do to prices versus the available supply we have, they're not good. They haven't been good for a while, and I think that the last sort of hope for the bulls, if you will, is that we get an early cold winter that stokes heating demand, and that could save the day for energy investors to a degree. But we'll be right back in the soup again if we start to warm up in mid-January, early February.
All right, energy is obviously a lot more than oil. Natural gas has become a bit of a phenomenon globally. Those rising prices, what does that mean for the energy sector, and how can investors invest in this boom in natural gas?
Yeah, it's almost like become a meme commodity. The way it's been going so crazy. I'll tell you this, Frank. For starters, here in the U.S., going into the winter, as of right now, we're in great shape. Storage levels versus last year, only about 6% lower than last year, only about 10% lower than the 5-year average, which puts them in the range of normal. Okay, let's go long-range meteorologist here for a second. There's a La Nina phenomenon in the Pacific right now for the 3rd straight year. That should produce a winter where we get some cold days, but we'll also get plenty of balmy days here in the Northeast like we have seen over the past couple of years. So we should be okay. The second saving grace here for natural gas is that in Europe, the storage levels there, too, are rising rapidly. They are attracting global liquefied natural gas like it's coming out your ears there, record amounts. So they too may get through this parade of horribles that's been put forth in front of us. Natural gas, though, is certainly the fuel of the future. It's certainly, to the extent any of these energy stocks, particularly the integrated stocks or the pure play E&P and natural gas, like an EOG Resources, let's say, to the extent they get taken to the woodshed here with everything else right now, they are definitely buys, because the vulnerability to energy tightness and shortages does remain sky high. But I wouldn't buy into the sort of, the sky is falling narratives that have been floating around out there over the past couple of months.
Yeah, natural gas.